Hi, how are you today? Welcome to our today's session. Today, we want us to look at group accounts. Remember, I'm giving you this particular session from RCM Online College. And again, I'm underscoring online because ours is 100% a virtual training platform for accountants in East Africa. Should you be interested in our tutorials, please get in touch with us. This is our number 0719 525,000. So today I would want us straight away to use very few minutes to showcase how we compute goodwill, in a consolidation process. So I want to share my question with you here. It's May 2019 question number 2, financial reporting, May 2019 question number 2. Fanaka Limited acquired 90% of the ordinary shares of shillings 10 par value in Mali Limited on 1st January 2015, when Mali Limited had revenue reserves of 1,500 million. So the most important thing is that we acquired quite a high stake in Mali, meaning straight away 90% is high, meaning straight away that Mali, even without any further ado, I'll be able to mention right away that Fanaka here becomes the parent. Of course, Mali becomes who? A subsidiary. On 1st January 2015, when Mali had those revenues. We are told here that Mali Limited acquired 160 million ordinary shares of 10 par value in Kwetu Limited on 1st January 2016, when Kwetu Limited had revenue reserves of shillings 500 million. So, ladies and gentlemen, I would want straight away to start with our first step, which is ascertainment of what here the group structure. So the first thing you need to do is to come and give us the group structure. So group structure. So we have a company here called Fanaka, which acquired who? Mali, and the Mali went ahead to acquire a company. Mali went ahead to acquire a company known as Kwetu, Kwetu. So what do we have here, ladies and gentlemen? What we have here is that Fanaka acquired 90% of Mali. 90% is way above 50%. And there is nowhere they are telling us that Fanaka ceded control of M. So straight away, F will be called the parent company. And this M becomes what here? A subsidiary. Very important. A subsidiary. And then now we have Kwetu here. For Kwetu, which is K there, we are told it's Mali that made the acquisition. So Mali acquired 160 million ordinary shares of 10 par value in Kwetu. So it means that Mali acquired 160 million shares. I can leave out the millions. So 160 out of how many shares does Kwetu have in total? How many shares does Kwetu have in total? Kwetu, if you look at the statement of financial position here, Kwetu has got how many shares? You'll be able to see here. Ordinary share capital under Kwetu, column of Kwetu is 4,000. But now remember, 4,000, this is money. I need to change this to nodes. I need to change this to number of ordinary shares. So how do I change this to number of ordinary shares? You'll take the 4,000 divided by the par value. Par value, remember, here is 10. So you take 4,000. Whenever you want to convert share capital in shillings to share capital, or rather to number of shares, what you do is to take the share capital that you are given here, and then you divide this by what here? By par. So you'll take 4,000, you divide by 10. So 4,000 divided by 10 is 400. So in this case here, then what is 160 divided by 400, and then you multiply this with 100 for purposes of what here? Changing this to a percentage. So what do we have here at the end of the day? So at the end of the day, this is what we shall have. We have 160, divide this by, so it's 160, divide this by 400, times 100, I'm getting 40%. So I'm getting 40%. So remember 40% falls in which category? In the category, remember our categories, that if, for example, we have a parent company, rather than an investor company, this investor company, for instance, has got a company A, it has got company B. Company A, in terms of quantitatively, company A will be called a subsidiary if a subsidiary of the investor, if this investor has shares which are more than 50%. So here we are talking of more than 50%, more than 50%, more than 50%, more than 50%. So here it's more than 50%. Then A becomes a subsidiary. What if, for example, we had an investment of 40% in B? So of course, 40% will be falling in this class, 20% all the way to 49.999%. 20% to 49.999%. This kind of an investment, of course, will be falling under what we call this. If your investment falls in this bracket, then your investment here will be called what here? Will be an associate, will be an associate, will be an associate. Fortunately for Section 3 financial reporting, now they have dropped this associate concept from the new syllabus. From the new syllabus, I'm only capturing it for purposes of our group structure. Otherwise, we'll not be doing associates in Section 3. That's very important for us to know. So, ladies and gentlemen, here, K, of course, will be an associate of M. And if it's an associate of M, automatically it becomes an associate of this company. So it is an associate of the group. I've always tried, or rather seen students trying, taking this percentage times this percentage. No. Ladies and gentlemen, when you are just appraising to know the status of the investment, if this K is an associate of our subsidiary, if K is an associate of our subsidiary, it also becomes automatically an associate of the parent company. An associate of the parent company, the shareholding, the percentages here notwithstanding. The percentages notwithstanding. So that should have been the first thing for us to do in this particular what here question. Once you get the group structure correctly, then every other thing will fall in place. The group structure must be ascertained. And once now you have been able to ascertain the group structure correctly, the next thing that you now need to come and do is to come and look at the net assets of the subsidiary. So give us the net assets of the subsidiary. Net assets, if you remember from our previous sessions, net assets are what here? We always look at net assets from our equity perspective. So give us the equity components of the subsidiary. So when we talk of equity, we are looking at things like the share capital, we are looking at things like the share capital. We have here the share premium. We have the share premium. We have in this case here, retained earnings. We have retained earnings. And then of course, we'll be having any fair value adjustments. So remember that you have to give us these net assets at acquisition and at reporting. Very important, at acquisition and at reporting. At acquisition and at reporting. So then what do we have here, somebody? Come and look at the equity components of which company? Of Mali. Remember, Mali is the only subsidiary we have in this question. So Mali, please go to the equity component. So we have the ordinary share capital of Mali. It is 6,000. So remember, ordinary share capital will not keep on. Ordinary share capital and the share premium, 2,500. Those ones will not keep on fluctuating for the subsidiary. So in this case here, ordinary share capital at acquisition is 6,000. So the same in this case here will be applicable at reporting. At reporting, 6,000. 6,000. The same case here with the share premium. So share premium at acquisition you've seen, or rather at reporting is 2,500. The one given in the financial statement is at reporting. So automatically the same will be applicable at acquisition. So retained earnings, you have to be very careful with retained earnings. What we have here is at reporting. So we have retained earnings, they're calling them reserves, revenue reserves at reporting is 2720. So revenue reserves, they're calling this revenue reserves. And the revenue reserves, what do we have at reporting? Revenue reserves at reporting is 2720. Revenue reserves at reporting is 2720. And then we have, in this case here, revenue reserves at acquisition. When we were acquiring this subsidiary, what amount do we have there? What some books will be calling pre-acquisition. So revenue reserve at acquisition, we are told here, Mali Limited acquired, Fanaka Limited acquired Mali on this date. And on that date, Mali had revenue reserves of 1,500 million. Our figures are in millions. So 1,500. So in this case here, we have revenue reserves on acquisition is 1,500. And then we look for information of what year, fair value adjustments, the revaluations basically. So do we have any revaluations in this question, really? Do we have any revaluations in this question? If you look at this question pretty well, on 1st of December, Mali held the stock. This is for unrealized profits on stock. Number 2, in the year ended, Fanaka Limited made sales. Again, this is for UPS at the end closing. 3, all the 3 companies paid interim dividend will not affect us in fair value adjustment. Intercompany outstanding balances, this again will not affect us for fair value. Any goodwill, that will not affect us at all. 6, fair value of tangible assets were not materially different from their book values on the date of acquisition. Acquired its control in Mali, and on that date, Mali Limited acquired its holding in Equator Limited. So there were no fair value adjustments. So fair value adjustment, 0, 0. Fair value adjustment is what here? Is 0. Fair value adjustment. So the fair value adjustment, of course, as you've read there, is 0, 0, right? And then come and give us the totals. The total acquisition, if you add the 3 figures, you'll end up getting 10,000. For reporting totals, net assets, you'll end up getting 11 to 20. So the difference between the two is what we call post-acquisition profit. PAP. Post-acquisition profit is the difference between the two. And this post-acquisition profit is what will be shared out between the parent and the subsidiary. In accordance to their what year, their percentage. Like now the parent here owns 90%. So what we call non-controlling interest will be owning what year? 10%. So that will be shared out, but that is another step, a different step. Today, I'm just here to teach you how we get what we call goodwill. That is a lesson of today. The objective of today is to calculate goodwill. And from there, I'll be able to go to my 3rd step. So my 3rd step is this important step of what here? Of goodwill. So my 3rd step is this important step of goodwill. So goodwill, what do we have here under goodwill? So under goodwill, remember goodwill, it's quite a simple thing to calculate. We shall look at our investment in this subsidiary. How much do we invest in the subsidiary? So our investment in the subsidiary has 2 components. We have the parents consideration. So the parent gave how much? The parent gave how much for this great exercise? How much did the parent pay? So they never gave us the exact procurement price here, but if you look at your statement of financial position, you'll be able to see the investment in Mali. And you'll be able to see that Fanaka, the parent here, paid 8,400 for that investment. To buy Mali's shares in Mali, they paid 8,400. Remember, they never bought 100%. They only bought what percentage? 90%. Meaning that there is a there is another investor who bought this balancing figure. So in this case here, the parent company bought 90%. So then 10% was bought by NCI. 10% was bought by NCI. So come and give us the NCI's consideration. The NCI's consideration. The NCI's consideration. So NCI's consideration, there are two ways of getting this. In most cases, you'll be given the fair value of non-controlling. In most cases, you'll be given the fair value of non-controlling. Fair value of non-controlling in most cases. But in this question, the examiner never gave us anywhere anything to do with fair value of NCI. That was not given. It's not given. So if it's not given, then what do? Then we shall be able to apply what we call the partial method. What we call the partial method. So we shall apply the partial method. And the partial method means what here that you come here and take the NCI's percentage of the net assets. NCI's percentage of the net assets. Remember, when we are calculating goodwill, we use net assets at acquisition. Whenever we are calculating goodwill, we use net assets at acquisition. So the total net assets at acquisition were 10,000. So I'll take 10% of 10,000, which will give me what here? 1,000, like that. Meaning, ladies and gentlemen, that the total consideration, the total amount that we gave to be able to acquire now 100% of the subsidiary was 9,400. 9,400 is what we gave to acquire Mali Limited. And then from there, we'll come and compare these to the net assets of Mali, net assets of the sub, net assets of the sub at acquisition. We can see at acquisition, this subsidiary was worth more. The worth of this subsidiary was higher. So meaning that we gave less than the value of the subsidiary, meaning that we are lucky, we bargained. So then at the end of the day, if you subtract this, you'll be able to get a negative what here? 600, a negative 600. So these are negative 600. So basically this negative 600 will be your negative goodwill. Although you don't call it negative goodwill, in the IFRS language, we'll call it what here? A bargain purchase. So it is a bargain purchase, which basically is a gain, which will go to our income statement. This cannot go to our statement of financial position. So the bargain purchase here is 600. The bargain purchase is 600. The bargain purchase is 600. So, ladies and gentlemen, should you want more information about this, please join RCM Online College by calling this number. These are some of the topics that I've given students quite a lot of a challenge. But once in this case here, you have got great tutors. This basically becomes something that is very easy for you to do what here to handle. Look at even this method. Not many teachers use this method. I'm not saying that I'm the best, but given what I do, because as you know, those that I have taught before, you know, my work out there, apart from teaching out there, my work is group accounting. I'm a group accountant. So I'm teaching you things in a very practical way. So please join us today. Our rates are very good. Just call this number and we shall be able to serve you. Thank you very much and be blessed.